everyone. Welcome to today's US Open live webinar. I'm your host, Nikos Zaboura, Senior Market Specialist at FXCM. It is Thursday, June 1st, the first session of June. 10 minutes before Wall Street opens, as always. This week started a bit slow, but things have heated up since. The US debt ceiling remains in the spotlight. We also had fresh Fed commentary that caused another repricing in the expectations around the policy path, ahead, of course, of Friday's NFPs and a few other things that we will be talking about today. Before we do so, however, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Okay, let's go ahead. So we already have Euro USD on our screens. Let's go through some of the latest events. So the debt ceiling agreement, as we already said, there was a debt ceiling agreement, and the relevant bill cleared the first hurdle, which was the House of Representatives, which approved it. Now it needs to pass through the Senate as well before it goes to President Biden's desk to sign it into law. Meanwhile, there was another shift in expectations around the next move, around the Fed's next move. We already talked about on Tuesday how markets had come to expect another 25 basis points increase in the upcoming meeting after the hot PCE inflation report. However, two Fed voters made the case for skipping a rate hike in June yesterday, and market pricing adjusted accordingly. CME's Fed Watch tool currently sees a pause at the next meeting in mid-June, but still prices in one more hike after that. Now, we also got some comments from the ECB as well on the hawkish side. So let's talk about the technical outlook. First, the pair breached the 200-period EMA, a critical resistance of which we have spoken multiple times, this region here. And this exposes the pair to the 2023 lows at 1.0481. Although, again, sustained weakness still seems a bit hard at this region. The pair, however, finds support today after the new Fed repricing, and the ECB is still expected to deliver more hikes than the Fed, although today's preliminary CPI showed a significant cooling from Eurozone in both core and headline figures. However, we still get some hawkish remarks from Fed officials, including from President Lagarde, who today said that we need to continue our hiking cycle. So the pair does find support from the combination of those things and may get the chance to push towards the 200-period EMA and the lower border of the daily Ichimoku cloud at 1.0840 region, but we're cautious, doesn't inspire confidence yet for bigger advance. Now, I said that the current region is critical. Why? Because if we go to the daily chart, we can see that back in the March dip, this had been tested again. This 200 period EMA had been tested again, but held, and while the RSI was at similarly oversold level. So if recent history is any guide, we would expect that to hold again, but there are other factors at play as well. Now let's go to US oil, which takes another beating this week as China's factory activity from yesterday's official data from the NBS showed another contraction in May. Again, China is the world's largest importer of oil. There have also been some cracks in the Saudi-Russian front ahead of Monday's OPEC Plus meeting. The Saudi energy minister had warned speculators recently that they could be in for some pain, in a hint that perhaps further production cuts could follow. However, Russian President Vladimir Putin noted that energy prices are becoming economically substantiated, and the deputy prime minister, Mr. Novak, doubled down, telling the Russian media, according to Reuters, that he doesn't think that there will be any new steps. Now, the technical outlook has not changed much. It remains vulnerable to the 2023 lows and a support region a little bit below it, starting from around 60 to 70. But similarly here, it's hard to see sustained weakness at this below current level, let's say, and around the 2023 lows. The commodity tries to stabilize today on prospects of successful resolution to the US debt ceiling drama, and that could end this repricing in the Fed, and that could give it the chance to rebound towards the critical region of 73, 73.80, where you can see this significant confluence of resistances. But once again, we struggle to see further gains past this level as things stand now. And let's move over to SPX 500, the broader US index, as we're a couple of minutes before US Open, and then talk about what's ahead. Now, the US index is having a poor week after a mixed month, and this creates risk for sub 200 period EMA moves. Such outcome would bring 4,004.80 in the spotlight. However, the downside seems well protected by a thick daily Ichimoku around this line. However, the slide is contained today, or tries to move into positive territory, mainly because of the dovish repricing and optimism around the debt ceiling. Above that 200 period EMA, bulls are in control and can set fresh 2023 highs at 4,237. Although we're cautious at this stage for moves past the 4,326 resistance. Now, there are key events ahead which will likely determine the trajectory of both Wall Street and the US dollar. So let's talk about that a little bit. The main event, of course, is Friday's jobs report for May. The labor market is very tight despite some signs of loosening. Jobs gains had picked up pace in April. Wages increased and unemployment had fallen back to its 5-decade lows. Now, another strong report would make a Fed pause harder, but weaker data would probably allow policymakers to stay in the sidelines, which at this stage is what markets price in after that new shift in expectations that we talked about at the beginning. Before that, we expect the jobless claims and PMIs from the US all on Thursday. Of course, the Senate vote is also in focus. Once again, we remind you that the Senate needs to also approve the bill. Successful outcome could enable the Fed to pursue a more aggressive path. Now, other than that, starting next week, OPEC Plus meeting on Monday, we talked about the rifting between Saudi Arabia and Russia. The truth is that it's hard to hike again, to cut output again, given the already massive output program after the new reductions that kicked in at the beginning of May. But we're going to have to see what happens. And on Tuesday, before our next session, the Reserve Bank of Australia announces its latest decision. It had raised rates again in May after a brief pause and kept further tightening on the table. Since then, wages grew 3.7% in Q1, although this may not be enough to raise more concern around inflation, which the RBA believes it has peaked, while unemployment increased to 3.7% in a sign that the tightening cycle is having an effect. So there is a case to be made for another pause, but the door has remained open for more tightening. So that's it from today's US Open Live webinar. We'll talk again on Tuesday, same time, 10 minutes before Wall Street opens. Thank you and have a good evening.